So, big tech is absolutely booming. They're reporting record revenues. The AI revolution is in full swing. It all sounds great, right? But if you look a little closer at their finances, something really weird is going on. A paradox that has Wall Street, well, let's just say they're paying very close attention. So, what is this paradox? It's kind of bizarre. We're seeing these giant companies announce fantastic, record breaking results only to watch their stock prices just tumble. On the surface, it makes absolutely no sense. Let's dig into a perfect example to see what's really happening. All right, let's talk about Amazon. In their fourth quarter, they posted a massive revenue of over $213 billion. That is a 14% jump from the year before, totally smashing what all the analysts expected. I mean, by any measure, that's fantastic news. But the market, it did the exact opposite. The stock plunged 8%. So what gives? Yeah, that reaction feels completely backwards, doesn't it? It tells you that investors aren't just looking at the money coming in the door anymore. They're looking at something else, something buried deep in these financial reports that has them seriously spooked. And that hidden detail, the real key to this whole puzzle, it isn't about the billions of dollars that they're making. It's about the hundreds of billions, and yeah, potentially trillions, that they are about to spend. So, hidden away in their reports, Amazon announced a plan to invest a staggering $200 billion in capital expenditures in a single year. Now, just for context, that's up from about $131 billion the year before. This isn't just a small increase, this is a monumental, all-in kind of spending plan. And you better believe Amazon is not alone. What we're witnessing right now is an industry-wide AI arms race. Google is planning to spend up to $185 billion. Meta is looking at up to $135 billion. The price to even compete in this next generation of AI is now officially in the hundreds of billions of dollars. When you add it all up, the total investment needed for this whole AI and data center boom could be more than $5 trillion in the next few years. That's according to analysts at JP Morgan. The scale of this is it's breathtaking. So what are they actually buying with all this cash? I mean, what does a multi-trillion-dollar shopping list even look like? Okay, so the lion's share of this money is going toward building the physical backbone of this AI revolution. We're talking about vast, sprawling data centers. And you can't really think of these as server farms anymore. They're more like AI factories, built for one single purpose: immense computational power. And inside these factories, you'll find this highly specialized, custom-designed hardware, like Google's tensor processing units, or TPUs. These things are basically AI accelerators. They're chips that have been engineered from the ground up to handle the massive parallel calculations that AI models need. And they're way more efficient at it than your standard computer chips. This build-out is so huge that it's actually creating new real-world problems. Even Google's own CEO has said that the top questions aren't just about software anymore. The biggest bottlenecks are now physical: getting enough power, finding enough land for these facilities, and just navigating the super complex supply chains for all this specialized hardware. So, with spending this ridiculously high, where is all the money coming from? You know, for the first time in a long time, the answer isn't what you'd expect from these tech giants. This quote from an investor, Tomas Tungus, just hits the nail on the head. For decades, these tech companies have been cash-generating machines. They could pretty much fund anything they wanted from their own profits. Well, that era is over. To fund the AI race, they're turning to debt markets on a scale that we've just never seen before. And they are tapping every single source of funding they can find. We're talking traditional blue-chip bonds, higher-risk junk debt, and even the huge, less regulated world of private credit. They are turning over every financial stone they can find to make this happen. This new reality of massive, complex spending has made this discipline called FinOps absolutely essential. It's not just a problem for the finance department anymore, it's a core operational focus. Companies now have to track every single dollar of their cloud spending with extreme prejudice, because these costs can spiral out of control fast. All this borrowing and spending creates another risk that has investors really worried, something called circular economics. For instance, Microsoft stock took a huge hit after it revealed that almost half of its cloud backlog was tied to OpenAI, the company that Microsoft itself has invested billions into. It creates this risky financial loop that makes it a lot harder to see what the real growth is. And this risk isn't just with one company.
Analysts are warning that this financial strain is spreading. Barclays actually used the phrase, the contagion is spreading, when they pointed out that Oracle's massive AI spending was hurting its credit profile, potentially even pushing it toward junk status.
Okay, so what does this high-stakes, debt-fueled gamble mean for the rest of us? Why does any of this matter if you're not in the boardroom of a big tech company? Well, because these companies are borrowing on such a massive scale, the AI race is fundamentally changing the investment world. As one strategist pointed out, your bond portfolio, which has historically been a safer bet tied to interest rates, is now becoming directly tied to the performance of tech companies. And at the same time, the stock market has become incredibly concentrated. You've probably heard of the Magnificent Seven: Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla. Well, those 7 stocks now account for about a third of the entire value of the S&P 500. This makes it really hard to truly diversify, and it means the ripple effects of this AI gamble, whether it succeeds or fails, are going to be felt across the whole economy. Which leaves us with the final trillion-dollar question. The next technological revolution is here, no doubt about it. But it's being built on a mountain of borrowed money. The potential rewards are absolutely immense, but as investors are now starting to realize, so are the risks.